Welcome back, everybody. Today, we're going to be taking a deep dive into the world of market beta estimates. You know, that whiskey indicator that we've been relying on in finance for forever, basically, since Markowitz and Sharpe.
Right, yeah.
And, you know, it tells us how much a stock tends to move with the market, but there's a catch, right?
There's always a catch.
There are so many ways to actually calculate beta.
Yeah.
And the paper we're looking at today tackles the question, how do you judge which estimate is most accurate when the quote-unquote true beta is like this invisible source we can't actually see?
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
It's a real head-scratcher.
Okay.
It's a challenge that's kind of plagued finance for a long time. A lot of the past approaches, they try to compare estimates to future betas, assuming that those would be close to the real thing.
Yeah.
But that assumption in and of itself, you can never really test it. So this paper tries to completely sidestep that problem.
Okay, so how do they sidestep it?
Well, instead of trying to chase this true beta, they came up with a way to judge the estimates on their own merit, so to speak.
Interesting.
And they use what they call a single index representation of returns. Think of it as like a flexible framework
Okay.
that doesn't lock them into assuming that one specific asset pricing model is the be-all, end-all. It lets them work with a whole bunch of different models and still be able to make these comparisons.
So within that framework, they developed a measure called gamma.
Exactly.
And gamma acts like a signal strength indicator.
That's a good way to put it.
So a higher gamma means the estimated beta is likely closer to the true beta, giving us a more reliable signal about a stock's risk.
Exactly. And I think what's particularly interesting here is how they break down the accuracy of these estimates into two parts: noise and bias.
Noise and bias.
Noise is like that random static that can mess up a signal.
Right. Whereas bias is a systematic tendency to either over or underestimate the beta. And what they actually find is that noise is the bigger issue when you're trying to rank stocks by their true risk.
That's a really helpful distinction because you could have two methods that have similar levels of overall accuracy, but the one with less noise may be preferable.
Right.
Because it's giving us a clearer picture.
Exactly.
So they tested this new method on 12 different beta estimation techniques,
Right.
including some popular ones and even option-implied betas.
That's right, covering a lot of ground. And this is where things get really interesting, right?
Yeah.
For the most part, all those fancy techniques, they weren't significantly better than just the basic OLS method, which is kind of like the standard approach. There were a couple of standouts, though. The Scholes-Williams beta consistently showed a stronger gamma, so more reliable signal. But I think the real surprise for me was that simply averaging all the different beta estimates actually performed better than any single method on its own.
That is kind of surprising, yeah.
It's like the wisdom of the crowds. Each estimate has its own little quirks and biases, but together they seem to balance each other out.
That's a good point. It highlights how each method might be capturing a slightly different aspect of risk, and by kind of blending them all together, you're getting a more holistic view.
Yeah, you get that combined wisdom.
Exactly.
Okay, so they also compared their findings to something called realized beta, which is calculated based on actual historical returns.
Right. But here's the thing about realized beta. It's backward-looking. Certain methods, like the Scholes-Williams beta we mentioned, they try to account for how stock prices adjust over time, you know? Realized beta misses that nuance. It's just taking a snapshot of what already happened.
So if you're relying on realized beta, you might be missing part of the story, especially when it comes to these methods that are trying to capture these delayed reactions in stock prices.
Right.
So it's not quite telling the full picture.
It's like judging a basketball player's shooting ability based solely on how many points they scored in their last game, you know? You're missing how they set up their shots, their form, all those other factors that contribute to their overall skill. It's just one data point.
Yeah. Okay, so they also looked at whether any of these beta estimates could actually predict future stock returns. What did they find there?
Yeah, so this is where it gets really interesting. None of the betas, regardless of how they were calculated, showed a very strong connection to future performance.
Wait, so you're telling me this classic measure of risk, this thing investors have been using for decades, it doesn't actually tell us which stocks are going to go up or down?
It seems that way, at least based on their findings. And I think that's why it's so important to remember that beta is only one piece of the puzzle. It might tell us about a stock's volatility relative to the market, but it's not a crystal ball for predicting riches.
It's not going to tell you which stock to pick to get rich quick.
Exactly.
So if beta doesn't hold the answer to predicting returns, where does that leave us? What other factors should we be considering when we try to assess an investment?
Yeah, it's a great question. And it's one that, researchers are constantly grappling with. If beta doesn't reliably predict returns, what does? It kind of speaks to the complexity of financial markets and maybe even the limits of our understanding at this point.
Yeah, and we've been talking about beta as if it's this universal concept, but this study focused specifically on the U.S. stock market. What happens when we kind of zoom out to the global landscape?
That's a really key point because the U.S. market, it's huge, but it's still just one piece of the global puzzle. So it kind of begs the question, would these findings about the beta estimates hold true in other markets, especially those with different structures and regulations, different investor behaviors?
Right, thinking about emerging markets, for example, where volatility and information transparency can be quite different.
Exactly. Risk might be perceived and priced very differently in those markets.
Yeah.
And the accuracy of these different beta estimation methods, it could vary significantly. It's a really, important area for future research.
This whole discussion makes you realize how much we still don't know about financial markets.
Yeah.
Even something as fundamental as like measuring risk is still full of all these unanswered questions.
It is. It's a humbling reminder that we're constantly learning and refining our understanding of these complex systems.
Yeah.
Which is also kind of exciting because it means there's always more to discover.
Speaking of discoveries, one of the things I found really fascinating in this paper was how they examined all these different approaches calculating beta. Like you have the classic OLS method, but then there are all these variations, each with its own kind of logic and assumptions.
Yeah, and I think the sheer variety of those approaches speaks to how researchers are always looking for ways to improve our understanding.
Right.
And capture these different nuances of risk, like, for example, the Visages beta that tries to kind of smooth out the extreme values by shrinking that OLS beta towards the market average.
Okay.
And the thinking there is that, those extreme values might just be noise.
Right.
And by pulling it towards the market average, you're getting kind of a more stable and reliable measure.
So it's like trying to filter out the static.
Exactly, to get a clearer signal.
Yeah.
And then you have methods like the Frazzini-Pedersen beta. And that one was designed to capture this whole phenomenon known as betting against beta.
Betting against beta.
Yeah. So their research suggested that low beta stocks, the ones that are traditionally considered less risky, they might actually outperform the high beta stocks in the long run.
Oh, so it's like challenging that traditional notion that higher risk always equals higher reward.
Exactly. And their method, it incorporates both volatility and correlation with the market, specifically to try to identify stocks that might benefit from this betting against beta strategy.
It's fascinating how even like slight differences in how you calculate beta can lead to very different interpretations of risk and potential return.
Yeah, for sure.
And it kind of reinforces that main point of the paper, right? Don't blindly trust any single beta estimate.
Exactly. It's like getting a second opinion from a doctor. You want to gather as much information as possible before making any big decisions.
Right, right. And speaking of different perspectives, the paper also delved into something called option-implied betas.
Yes.
Now, these are derived from the prices of options contracts.
Right.
Which are essentially bets on where a stock's price is headed.
Yeah, that's a good way to put it. So option prices, they're influenced by a number of things, but one of the key things is the expected volatility of that underlying stock.
Right.
So by analyzing the prices of options with all these different strike prices and maturity dates, you can get a sense of the market's perception of that stock's future volatility.
So it's like tapping into the collective wisdom of all these traders who are constantly kind of assessing the risks and rewards.
Exactly. And what's interesting is that these option-implied betas, they seem to be quite good at predicting those short-term price movements, even better than some of those traditional methods we've been talking about.
But as we discussed earlier, they don't do as well when you extend that time frame further out.
Right, exactly. Which kind of suggests that options markets, they might be really good at capturing that short-term sentiment, those short-term expectations.
Yeah.
But they're not necessarily a crystal ball for predicting those long-term trends.
Right. It's a good reminder that different tools and methods might be better suited for different purposes and different time frames.
Absolutely.
Yeah. What are your thoughts on that? It definitely seems like, the right tool for the job depends a lot on what questions you're trying to answer. Short-term versus long-term. That's huge in the market.
Yeah, for sure. And that brings us back to one of the kind of fundamental questions in finance, right? What drives stock returns? If it's not beta, then what is it?
Right. Because the paper didn't find any significant relationship between any of the beta estimates and actual future performance. So it challenges this classic idea, right, that higher risk should equal higher reward.
Yeah, it really does. It suggests that the relationship between those two things might be more complex than we traditionally thought. There are other factors at play here.
So where do we go from here? If we can't just rely on beta for our investment decisions, what other signals should we be looking for?
That's the million-dollar question, and it's one that, investors and researchers are always trying to figure out. There are a lot of different approaches. Some focus on the fundamentals, looking at a company's financials, their management team, the competitive landscape.
Right.
Others might use technical analysis, looking at price patterns and trading volume, trying to identify trends. And then there are those who try to incorporate behavioral factors, understanding, the psychology of the market.
Right.
How investor sentiment can really sway those prices.
Yeah, it's like a whole other layer on top of everything.
It is. And of course, a lot of investors use a combination of all these approaches, trying to piece together the puzzle from different angles.
Makes sense.
There's no one right answer. What works for one person might not work for another. It's really about finding an approach that aligns with your goals, your risk tolerance, how long you're planning to invest.
It's very personalized. This whole deep dive has definitely made me think twice about how I view risk.
I think that's a good thing.
Yeah, and how it's measured. Beta is a useful tool, but it's not the whole story.
It's not. And I think what's key is to really be a critical consumer of that financial information. Don't just accept the numbers at face value, Dig a little deeper. Understand the methodology behind them and consider multiple perspectives before making any decisions.
Well said. A healthy dose of skepticism and a willingness to learn, those are good things to have.
For sure.
Awesome. Well, thanks for joining us on this deep dive into the world of market beta estimates. I hope you found it as interesting as we have.